So now, for the reason we're here, I won't waste much time in introducing our speakers other than to say that they are the brains behind our HPI and the forecast. Our speakers today are Brendan LaCerda from Moody's Analytics. He is the Associate Director and Senior Economist there. And we have Brian Tjoa from RPS, who heads up our data and analytics team. So Brendan, I leave it to you to take it from here. Thanks.
Thank you, Yvonne, for that kind introduction. I would like to start today by, focusing on three things. First, to reiterate what Yvonne said, it has certainly been a crazy 1.5, 2 years, for the housing market with the pandemic and everything. Looking at the high frequency data, though, looking at the RPS House Price Index, looking at housing starts, looking at building permits, looking at sales activity, it appears that the market is pivoting, that we are starting to turn a corner. And of course, when I say turn a corner, what I'm talking about is all these different house price measures, all these different housing market measures sort of coming down from those historic highs. So, we're seeing signs of a slowdown emerge, and I think that really gives impetus to the presentation today, which is, where are we going from here as we start to look towards, what does the post-pandemic economy look like? I think the two questions that emerge most clearly are, how fast are things going to slow down, and how much are they going to slow down? That's really sort of, I think, the key two questions we're going to try to assess in today's Outlook talk. To begin, though, I think it's worthwhile to at least take a brief stock of where are we right now. So just looking at a whole sort of raft of key macro indicators that I would be considering when I'm thinking about the housing market, and looking at where were they in 2019 Q4, just before the start of the pandemic, and where are they right now in roughly the third quarter of 2021 that just ended. So for some of these things, I'm using our estimate for the third quarter since we don't quite have that data yet. But looking at the landscape, what do we see? Right at the top, this boom in the housing market. Not only an extraordinary amount of house price growth, but also a burst of new construction. So housing starts, housing prices way up top. Similarly, the increase in housing prices is not just solely sort of reserved or restricted to that one asset class. We've seen asset prices increase across the board. So stock prices are up a huge amount since the pandemic started. But then we get into some of the more interesting things, or at least I would say we can sort of categorize a lot of these variables into three different categories, which is the things that boomed, housing, stock prices, the things that are sort of roughly back to where we started at the beginning of the pandemic, things like employment or GDP, and then there's a third category of things where we're still waiting for the recovery to complete or more fully occur. So you can see this really sharp divide between on one hand, goods consumption. We're all buying more stuff on Amazon, it's getting shipped to our house, goods consumption. But on the other hand, services consumption, still a lot of progress that needs to be made. That trips to restaurants or gyms, or going to the salon, get your hair cut. All of that type of spending is still quite depressed. So it's still a bit of a mixed bag when we look across the range of macroeconomic indicators. If you want to jump to the next slide. But I think ultimately, when we think about where is the housing market headed, as economists, we always come back to the labor market. The labor market is the bedrock of the housing market. In the simplest sense, your job generates the income necessary to qualify for a mortgage and make your monthly housing payment. So even though there was this disconnect between the labor market and the housing market during the pandemic, that bond, that relationship between the two, ultimately has to reassert itself. So, what we want to think about is, what's the state of the labor market? How much growth is remaining? Where are the pain points? So what we're looking at here is actually the employment to population ratio. And this is kind of a different version of the unemployment rate. The unemployment rate just looks at, the number of unemployed people as a share of the labor force. But sort of the technical problem with that definition is, you're not considered unemployed if you're not looking for work. So, people who may not be looking for work because, they're caring for a family member, childcare issues, or whatever the reason may be, they're not counted as unemployed. So that can sort of distort the picture a bit. So alternatively, what we look at is the employed population, the number of employed people as a share of, the 15 years and older population. So it removes that distortion created by, are people looking for work or people not looking for work? So looking at this employment population ratio and how much it's changed since the start of the pandemic, we can get a sense of, how much slack is left in the labor market, or, how much is left in the recovery. And, on one hand, you can kind of interpret this as, both like a good and a bad thing. So for the metro areas on the top of the chart, the Hamilton, Montreal, Toronto, Vancouver, they've made significant progress in their labor market recovery. On the other hand, looking down the chart, what we start to see is a lot more metros in the West, Saskatoon, Regina, Edmonton, Calgary. These are places where there's still a lot of labor market slack. So I think the key takeaway here is that, with the exception of Vancouver, much of the West still has more progress to make in its labor market recovery than the rest of the country. But I think it's sort of on the positive side, the way you can interpret this as there's a lot more job growth to be coming, down the pipeline for the West than there is in the rest of the country. And so, as you'll see sort of through a lot of, the later presentation, because there's still a lot more job growth to come in the West, that provides a little more of a tailwind to the West's recovery. And, we're still going to, be seeing some stronger numbers through the next few years than we would see in the rest of the country. So, the key thing to just remember before we actually flip away from, this picture to the next one is, whereas, Vancouver, the amount of slack in Vancouver is pretty close to the national average, a little ahead of the national average. There's a lot more slack if you look at like Edmonton or Calgary compared to the national average. And as I said, that's sort of one of the key things that factors into our forecast for employment. So if you jump to the next slide, sort of what we anticipate over the next few years is we're going to get much stronger job growth in Alberta versus British Columbia and the rest of Canada. So as I said before, one part of that is that there's just more slack. There's more progress to be made still in Alberta versus British Columbia. So where, we're expecting British Columbia's expected job growth pretty close to the national average, we should have a stronger pace in Alberta over the next few years. The other element of that is demographics. And I think we'll talk about this a little bit more later. But Alberta has stronger demographics, faster population growth than the Canadian average, than, British Columbia. British Columbia is still slightly above average. But those, one of the things we always look at as economists to say, what is the health of, this economy or this local economy? One of the places we always start is with demographics, because population growth is one of the strongest drivers of demand, whether it be demand for housing or, demand for all goods and services. What you really, if you're going to spot, if you're trying to spot economies that are in trouble, one of the surest signs would be a shrinking population. Because once the population starts shrinking, the whole economy starts to become a little bit screwed up. If you want to jump to the next slide. So, one other thing sort of, I'm sort of sticking with this theme of, before and after, what's changed. One of the other things that's really also going to factor into the forecast is how debt and the composition of debt and households' balance sheets, how have they changed over the course of the pandemic? So, one of the clearest things is this stark divergence. With the boom in the housing market, we also saw a boom in mortgage debt issuance. Year-over-year growth in mortgage debt took off with the pandemic. Interestingly, on the flip side, non-mortgage debt, credit cards, auto loans, personal loans, through most of 2020, they were contracting. So people were growing their mortgage balances and shrinking their credit card balances, which, if you're not going out to eat, if you're not traveling, maybe it's easier to cut back on credit card type expenses. But, with more people spending more time at home, people buying homes, mortgage debt has taken off. If you add these two categories together, we do have a net increase in debt through the pandemic. And the reason that is so crucial to the forecast is because going into the last recession, we already knew, Canadian households were highly indebted. Coming out of the pandemic, Canadian households are even more indebted than they were before. And this indebtedness creates an extra sensitivity to interest rate changes. So, when we start talking about the housing market outlook, really, top of the board key factor is how is the interest rate environment evolving? And the bad news for potential buyers is that every indicator is suggesting that interest rates are going up. If you could jump to the next slide. So, after that, a little bit of a dose of pessimism, I think it's at least worthwhile to focus at least a little bit on the positive side. Could you jump to the next slide, please? If I had to say, what is the one part of the Canadian economy that makes me most optimistic about growth, it would be what we're seeing with household savings right now. So, how much are households saving as a share of disposable income? We have a huge amount of excess savings in the economy. Household balance sheets are, still in pretty good shape despite this increase in debt because they are holding a lot of cash on hand. And sort of, as public health conditions normalize, as, the number of new cases subside, as we make further progress on vaccination, when consumers start feeling more comfortable about, going out and spending more money on services, the good news is they have the spending power available. They have this savings on hand. Now, the one risk is, do households treat this, excess savings more like income and spend it? That's what we expect to happen. The downside risk is, do households treat this savings more like wealth, and do they hoard it and do they hold on to it? Now that would be a little more concerning because that means this savings isn't going to translate into consumption growth. But right now, our baseline forecast is that consumers are going to spend out this savings. That consumption, that demand, is going to be really encouraging for business sentiment. And when businesses start to see demand coming back, they invest in more capacity. And you get this virtuous cycle where the recovery can maintain its momentum as the economy gets back to full employment. So, putting all these pieces together, if you want to jump to the next slide, what does this all mean for growth? And as economists, most frequently we look at GDP growth, that being, the market value of all goods and services that the economy produces. So, the darker blue lines, those are all these bars here. These are annual GDP growth projections for the next 2 years. What I'm showing is November in light blue, our most recent forecast, and May in dark blue, which was our forecast from 6 months ago. Because one of the things, the two things I wanted to highlight were, on one hand, we still expect really strong growth over the next 2 to 3 years. However, it is worthwhile to mention that, we have downgraded our expectations slightly since the middle of the year. So as I said, well, at least I think it's good to point out the benchmark between, good growth or bad growth for GDP would be about 2%. That's our long run average that we would, characterize as the dividing line between good and bad. So, clearly pandemic 2020, economy contracts, more than 5%, almost 6%. That was clearly, a terrible year. But, we had a really strong recovery in 2021 so far. We're bounced back really strongly. The question is, going into the years ahead, we're still at a very healthy pace in 2022. And even into 2023, we're still expecting growth to be above average. And as I said, a big part of this is built upon, expecting consumer spending is going to come back with even more force over the next few quarters. That demand also translates into strong investment growth as businesses start to feel more confident in the recovery. The reason for the downgrade in this picture is what's happening on the trade side. Namely, we knocked down our expectation for export growth because of all these issues with supply chain bottlenecks. So, in some sense, that's restricting the pace of the recovery. And listening to industry leaders and sort of what's the word on the street is that a lot of these supply chain issues are going to persist through most of 2022 likely. Namely for the auto industry, at least we expect it to continue for that long. But yes, still probably dealing with these supply chain issues through most of 2022. But by the end of 2022, these issues should have started to be resolved. If you want to jump to the next slide. Of course, one of the biggest issues, a lot of, we're all discussing at the moment is this issue with inflation. That inflation has accelerated quite dramatically. I think similar to what we were talking about with the labor market earlier. I think there are positive and negative interpretations of what's going on right now with inflation. Clearly on the negative side, things are getting more expensive. That hurts consumers' buying power. That means if prices are going up, we have to make some cuts elsewhere in order to, make sure we don't exceed our household budget. So on one hand, yeah, things are getting more expensive. That hurts consumers. That's a negative. On the plus side, though, this acceleration in prices is indicative of strong demand. In a very basic sense, if demand outstrips supply and we have a shortage, well, in the case of, in the instance where shortages occur, prices rise. So, the good news is for the economy, demand is in pretty healthy shape. The problem is, at least for the moment, is that the supply side can't catch up. And a lot of this is just a consequence of the pandemic. That, businesses cut back on capacity when the crisis first hit. They can cut back pretty quickly. It's a lot harder to, turn the lights back on and turn the factories back on and ramp production back up. There's also the issue of, businesses are a little hesitant about, are these high prices going to last? Is, this just a temporary phenomenon? Should I increase, my capacity? So, a lot of those issues are getting sorted out at the moment. But at the end of the day, high prices motivate firms to figure out how can I increase output. So, yeah, these high prices are going to endure for a while. We're still going to see high inflation readings into, early 2022. But as, central banks have been saying, as the Bank of Canada has been saying, this burst of inflation is a transitory phenomenon. So this is the picture they're referring to when they think about, what does this word transitory or temporary mean? It means that, we have this temporary bulge, this temporary spurt of inflation, but, likely by the end of 2022, we think the pace of inflation will normalize back to 2%, where the bank wants it to be. I think where the miscommunication came about is that this burst of inflation is lasting a lot longer than policymakers initially indicated. And if you can jump to the next slide. One more comment I wanted to make, because I would be remiss if I didn't talk about the outlook for Western Canada if I didn't also discuss oil prices. So looking at, rather than look at oil prices, which are elevated recently, I'd be interested to look at, how does Canada fit into sort of the global picture for the oil market? And I think one of the sort of the really interesting things to see is that Canada's share of global oil output has been slowly increasing over the last decade. But it's really Canada's increasing market share is really a function of sort of the problems in Venezuela and Venezuela's declining market share. That it really isn't the U.S. shale producers that at least for looking at the data, are the greatest threat to Canadian oil producers. So the bottom line is, the Canadian oil market's in good shape. Its market share has grown as a result of Venezuela's problems. If Venezuela could get its act together and start ramping up its production, I would be a lot more concerned for the Canadian oil market. But given how deep and systemic Venezuela's problems are, I don't think there's too much of a risk of this situation changing anywhere in the near future. So bottom line, Western Canada should be able to ride the wave, the benefit of this spike in oil prices. But we shouldn't put too much stock in. We shouldn't put too much faith in expecting that these high prices are going to continue. Our current forecast is that oil prices should start to normalize as OPEC starts to boost production. So we should see, we're likely around sort of short-term peak oil prices at the moment, and we should see those start to come in a little bit, over the next year or two. With that, sort of setting sort of the macro global picture, for the economy. In the next sort of portion of the presentation, we'd like to really dive deep into what's going on and how all of this is going to affect the housing market. So I'll turn it over to my colleague Brian, who's going to discuss some of the recent performance, and then I'll be back to talk more about the outlook. Brian?
Thanks, Brendan. Hello, everyone. If we could jump to the next slide. So I'm just going to orient you on the slide a little bit, and then we'll go a little bit into what it's telling us. And so this is our HPI, and this is actually specifically around the year-over-year growth rate. And why we like to see this is to understand what are those two trends or momentum that's happening in the marketplace and understand what's happening. And a large part of what we are seeing is this record high growth. And I know many of you experience it, but what I wanted to show in that small graph in the top left is over the last 15 years, you can see how it rises and falls, but you can see distinctly over the last, in the green box, how much it has actually risen and how historic it is in the last 15 years. The other piece that, that was really interesting for us is, for long part, the dance between single family detaches and condos have been pretty much in lockstep in terms of when they rise and fall. But since the pandemic, and the major graph on the bottom or in the center, maps from 2019 January to the end of October 2021. And when the pandemic hit, we saw the large separation, and the separation continued, where single families dramatically kept growing and condos growth rate relatively remained stagnant or steady. And we know this because of desire for space, offset home, ability to work remotely, no longer have to commute. All these benefits allowed. What we also saw is record growth in the number of areas, and over 90% of the cities across Canada, we saw year-over-year growth. And so a large part, as you can see, was driven by single family detached. The last piece I just want to call out on this slide is over the last 6 months, though, we're starting to see it start to come back together again. And condo is rising ever so slightly, but you can actually see the slowdown in the growth of single family detached. So it has dropped a couple percent, still positive, still great at almost 18%. But it has slowed relative to at its peak, call it back in May of 2021. Can we go to the next one? And so how does that map relative to some of the Western provinces? And I don't think it's surprising that BC mimics very close to the national numbers. And if you look at the orangey and the top blue line, the brighter the blue lines, they kind of mimic each other, and they're very, very similar. Whereas if you look at the remaining Western provinces, Manitoba, Alberta, and Saskatchewan, they've been relatively flat up until, call it, the end of 2020. And then you can see where it started to grow and fight back, and we're seeing now positive growth in 5+%. And this is a good sign that the growth is continuing across all of Canada, as well, specifically in the Western provinces. Can we go next? So this graph is a little bit a different slice of data, but just wanted to share some things with you. So the timeline, we've taken 3 snapshots in time. So back when, what was the performance back in November 2020, about 6 months ago at April 2021, and then at the end of October 2021. And the first row below that is British Columbia, and the second row below that is Alberta. I just took 2 provinces just for perspective. What we wanted to talk about here is, while the numbers all look very, very healthy in BC, we know that there's dynamic changes, and for sure the pandemic has influenced consumer behavior or desire for what type of properties and where we were considered to live. And we see that decentralization where you don't have to be as close to some of the city centers or hubs. And if I take BC as an example, in the very first row, you look at Vancouver, and they were showing 14.4% growth rate. And relative to BC, they were exceeding BC's numbers, right, as a whole. And, you know, as far back as April, we started to see that flip, right? And we're seeing now Vancouver's at 13% and BC is at overall 18%. And in most recent numbers, Vancouver has slowed definitively to 3.8%, which is very different from the overall provincial view. But the interesting part, when you look at other places like Abbotsford, which is outside of Vancouver, call it 40 kilometers east, give or take, you know, their numbers are super healthy. And then over the last several months, they're hovering around that 30% mark. And so that is different, indicative of what's happening, that people are considering markets that maybe not always traditional. And then if I take Alberta, another example, I took a smaller region, you know, just to demonstrate the level of granularity that's within the HPI, is we took Lethbridge. And Lethbridge, you can see that they have been declining as well. They started at 4%, you know, higher than Alberta's at 1.4%. And similar to Vancouver, they start to decline when they're now below Alberta's rate at 2.7 versus 4.6%. And then now they're basically flat or negative 0.8%. And, you know, comparatively, if you look at, I'm not sure how well everyone knows Lethbridge, but if you take some other areas that are outside them, Raymond as an example, 40 kilometers south of Lethbridge, they're at 24.4% year-over-year growth. So they are, you know, almost 5 times of Alberta's performance right now. And then Pincher Creek, which is around 80 kilometers west, they're sitting at 11.8%, so almost double of what Alberta is. And so, you know, those bedroom communities or areas that maybe are not as traditional as some of the, you know, more concentrated hubs, they are demonstrating some, you know, general strength in the marketplace. And what's driving the overall national number is we're seeing it all over the place, and it's not specific to any one hotspot. Can we go next? So a different visual. The chart is really small, and I'm not expecting anyone to see the numbers or to actually read all the different neighborhoods. but it's just to give you a reference point visually. And so this is Greater Vancouver. And if you look at the table on the left, green is good and obviously red is not so great. And you can see all the different geographical areas or neighborhoods surrounding or part of the Greater Vancouver area. It is indicative of what we're seeing. And we're seeing there's great strength and great positive numbers, not just in recent months and in recent times. It is spanning, this chart spans about a year and a half worth of data. The highlighted yellow bar on the table on the left, that's Vancouver. So they're not at the top of the mix. They are, closer to the bottom in terms of year-over-year growth. And so you can see how where they are relative to that. So it's not just relative to BC. The chart on the right, basically, it's just a geographical representation of an aerial view, so you can see the different neighborhoods. Some areas are obviously physically larger in space, but generally speaking, green is a great to see on this graph or chart. And if we go to the next one, and the next one is a similar chart. Now we're focusing on Calgary, and you can see that they're heavily predominantly green as well. The only thing you'll notice is that Erie Canada on the bottom is such a small area that actually on the bird's eye view of the geographical view, it doesn't actually show up. That's why there's actually no red, because it's so small, geographically speaking, that it is in there if you zoom in, but you don't see it on the graph or on the chart. But again, very similar story. And so what we're seeing in the marketplace is, while some things are slowing down, they are very positive. We're still seeing double-digit growth at a national level. We are seeing the return of condos and the gap decreasing, and we anticipate that will continue for many reasons that Brendan has talked about, and many things that we're seeing in the marketplace today. And overall, we just want to highlight is, while typically we usually see hot spots or very hot areas or marketplaces geographically across Canada, of the 1,500 neighborhoods, we are seeing that being over 90 to 92% of those areas are seeing growth. So it is not one area, not one property. The overall marketplace is showing a strength at this point in time in history. So that's about it. And I'll pass it back to Brendan to talk about the forecast.
Oh, thanks, Brian. I just wanted to also remind everyone, please submit any questions you might have into the dialog box of the WebEx presentation. Happy to answer any of your questions, either during the next few slides or wrap them all up at the end. If you could jump to the next slide. So as promised, sort of in our third act here, I want to pivot over and talk about what's the outlook for the housing market? What's the outlook specifically for the Western Canadian housing market? I think the two biggest things on my mind are interest rates and the related issue of affordability, which is a bit strained at the moment. But to start with interest rates, the biggest challenge for the housing market over the next two to 3 years is going to be rising borrowing costs. They are coming. Essentially, the Bank of Canada made a promise at their October meeting, where they really did make quite a big announcement that shocked financial markets a little bit. So the Bank of Canada has ended quantitative easing. So previously, in order to support lending, in order to keep interest rates low, the Bank of Canada was, printing money, buying up lots of debt. That's over. They're now in their reinvestment phase, which means they're going to hold the size of their balance sheet constant, and they're going to reinvest the proceeds of maturing assets. Eventually, so what we anticipate, though, is that by the springtime, this reinvestment phase is going to end, and the Bank of Canada will just allow assets to start maturing off their balance sheet. As they go through this process, that puts upward pressure on interest rates. Also, the Bank of Canada's forward guidance is pretty clear. They think the labor market is pretty close to, its potential, that, unemployment is getting back close to its, pre-pandemic rate. And, that recovery in the labor market means it's time to start hiking interest rates. Our current projection is that the Bank of Canada will start raising its overnight target rate in right around mid 2022, probably early third quarter of 2022. And once again, this is going to lift the entire yield curve. Short-term rates, long-term rates, mortgage rates are all tied to this sort of key overnight rate. So that means policy's tightening. If I had to describe the entire Canadian housing market outlook as succinctly as possible, I would say it's going to feel a bit like deja vu. And we have some recent experience that we can look at to see how the housing market responds to rising interest rates. We can look back at the 2017 and 2018 experience. House prices were flying high, double-digit rates of appreciation. Once the Bank of Canada started raising interest rates in 2017 and kept raising them into 2018, house price growth hit a wall. That across the country, what we saw is prices flatten out, and essentially that's a lot of what we expect to see over the next 2 years. Is that this double-digit rate of appreciation is going to slow down to a crawl. The prices are going to flatten out for a while. As I mentioned, the big part of this is just driven by what's going to be happening to interest rates. As I mentioned, because that ties into affordability. How much home you can afford, how much monthly payment can you make, depends on your income and what interest rate can you borrow at. So if you can flip to the next slide. So I did a little back of the envelope math here, which is to say, if I take the median home price value in each of these metro areas, and then I say, that median home price, what is the 5-year mortgage rate at that time? So you can compute, what is the median monthly payment going to be on the median priced home, and then calculate that as a share of the median family income. So, loosely you can look at this chart and say, what share of household income would you need to buy the average priced house in that metro area? Now, I didn't, there's no down payment included in this calculation. So obviously, these numbers would be a bit lower. But also, I didn't include any of the other costs, associated with, home ownership, repairs, depreciation, any other sort of maintenance cost, anything of that sort. So, those things I think sort of roughly balance out. But, really what the most, I think obviously what's the most striking in this picture is, in 2021, the average home would cost the average Vancouver family, 80% of their income, which is, to think about it, it's a bit mind-boggling. And it would say, how can such high valuations be sustained? Well, Vancouver proves that, they can be, sustained. That, roughly, affordability has always been at this very, uncomfortably high level, in the Vancouver area. What that likely speaks to is that there's a lot of, outside money that flows into the Vancouver real estate market, which, you can see has been a more recent phenomenon for the Toronto market. And then you see the Toronto market sort of trending towards that Vancouver type market. But there's really a stark divide in Canada between these, very high priced markets and also then, these much more reasonably priced markets. So, I guess there's good and bad news for the West here. So for Vancouver, already very unaffordable. That means it's hard for prices to really push much further, much higher. On the other hand, prices are still very affordable through, at least, the vast majority of Alberta, which should, as interest rates start to rise, that implies, that's relatively more favorable for the more affordable markets. So as we think about, rising interest rates, that means bigger monthly payments. That's a slight benefit to the previously more affordable areas like Calgary and Edmonton. If you could flip to the next slide. The other thing I wanted to highlight, something I mentioned earlier, out of all the provinces in Canada, Alberta has the strongest population growth projections, over the next decade. And this kind of goes hand in hand with that, issue of affordability, which is, more affordable markets are going to be, more attractive destinations for, people to move to. That's going to favor population inflows. So you get this sort of positive dynamic of, Alberta's relatively lower prices are going to be attracting people to move into the area. If you could jump to the next slide. So, focusing in on sort of a select, few metro areas, I wanted to pick 2 in British Columbia and 2 in Alberta. What we see is a lot of those dynamics that, Brian was describing, that, when the pandemic hit and people's preferences pivoted sharply towards, larger homes farther from the downtown urban core, that was a huge benefit to prices in places like, Abbotsford, outside the Vancouver area. Vancouver got, we saw, a pretty strong, appreciation of prices there too. But it was really these, areas outside of, the downtown urban cores where we saw the largest amount of price appreciation. The problem is, that increase in prices has really strained affordability. So looking ahead to 2022 and 2023, as those increases in interest rates, make properties even less affordable, that's going to put the most downward pressure on prices in, those previously high-flying markets like Vancouver and Abbotsford. But it's less of an issue. These rising interest rates are less of an issue for markets that, are very affordable, like, Calgary and Edmonton. So in terms of, where are we likely to see the strongest growth in prices over the next few years? That's likely to come in, those areas that, didn't see prices boom during the pandemic. I think the other thing to keep in mind is that, a big part of the boom in, the Abbotsford and sort of these surrounding type markets was because of this pandemic-driven demand, this change in preferences. The issue is that, that dynamic is largely played out. If the pandemic, motivated you to move, you've probably already moved. That, going into 2022 and 2023, we're not going to expect to see this, migration, this, people moving around or shifting the location of their home. So, that demand isn't going to be there to, keep helping out, the Abbotsford area. So that's why, we're seeing even like a little bit of a pullback in those types of markets, where, we still expect a little more growth in Vancouver. If you can flip to the next slide. So one of the things, stepping back a second and looking at like the national market, once again, we sort of see that feature that, Brian just talked about, where, the boom in prices was driven by the single family market. But, in contrast to, previous price cycles, we really didn't see any of that in the condo market. As I sort of hinted at before, this, picture for, year over year changes in house prices, is, it's almost the exact inverse of what we saw with interest rates. And that's why I brought up the experience of 2017 and 2018 and this idea of, housing market deja vu, where, we had the boom in home prices in 2016 and 2017. The second the Bank of Canada started raising rates, house price growth cooled off pretty quickly and then just sort of stayed flat for a while. And that is very similar to what the forecast looks like. We're coming off this boom right now. We're already seeing house prices start to slow. Given the pace of interest rate increases that we expect, house price appreciation is likely to reach a standstill in late 2022. And then it goes flat for a while. So, so 2023, even into, the first part of 2024, house prices stay still. Only then in, 2025, we see a reacceleration of prices, coming back to their long run trend pace. I think you can also think about it as, there's also, the labor market component to this story, which is, nationally, the labor market, employment growth is starting to cool down a bit. That means income growth is starting to cool down a bit, which, in terms of, affordability, slowing income growth doesn't help affordability. And so it's not until we really see wage growth start to accelerate in 2024 and 2025. And, at that point, interest rates start leveling off around 2024, 2025, that's when we see, house prices start to pick up again. And start to, as I said, reaccelerate back to their long run pace. The one thing, I think the one concern on a lot of people's mind is, we've just had this big run up in home prices. Brendan, you're telling me, these interest rate increases are coming. Why don't you expect house prices to, correct or fall in, the outer years? I think the big issue there is, thinking about the supply side of the market. Going into the pandemic, we were, Canada was just building too few homes. And, if we look at the inventory numbers right now, the inventory of homes for sale is still, below its pandemic level. The other part of the forecast I'll talk about in a second is the pace of home construction is slowing down, which, we probably could be building, more homes, even though the pace of home construction is quite elevated at the moment. We probably, I would like to see, that elevated pace of construction continue. The problem is, by our measure, with interest rates rising, with construction costs increased, housing construction will slow down. But the big thing that why don't house prices fall is because the market is still supply constrained. And given the constrained supply, that limits the downward potential for prices. And, I think what sort of really makes this clear is if we look at the projections for Vancouver in particular. So looking at Vancouver, what do we see? Single family appreciation is going to stay noticeably stronger than multifamily appreciation over the next few years. And we do have a bit of a pullback on the multifamily, a bit of a pullback for multifamily prices. And the reason is that, relative to a lot of other markets, new single family construction is a lot more constrained in the Vancouver area than it is in other areas. And a lot of the new construction we're seeing in Vancouver is heavily on the multifamily market. So if we take that issue of supply constrained and we look at Vancouver in particular, where the single family market is much more constrained, but multifamily construction has been much more brisk, what does that mean for the forecast for house prices? Well, continued stronger appreciation on the single family side and a little bit of a pullback on the multifamily side. If we could jump to the next slide. Oh, my mistake. Yeah, we're seeing the Vancouver market here, where we do have the stronger, pace of single family appreciation and the contraction, the year over year in negative territory on the multifamily side. So my apologies for that not lining up with the slide I was talking about. If you could jump to the next slide. As I mentioned before, how much, a big part of what factors into the price forecast is, what's happening on the construction side. And, there was this, really strong housing boom in Vancouver, a lot of it coming with multifamily. Whereas, what we saw in Alberta was a much sort of more steadier pace of construction. So, one of the issues in the Vancouver market is there's going to be a lot of multifamily inventory to clear. That's going to contribute to the downward pressure on prices. But that is not the same case for Calgary and Edmonton, which should lend itself, as I said, to that stronger pace of home price appreciation. If we could jump to the next slide. The last thing I wanted to comment on is, for all the, the metros and the census areas that we produce house prices for, we also produce a host of alternative scenarios. Upside scenarios and downside scenarios. And we generate these scenarios using like different sets of assumptions. So in the case of, if we want to think about, what's the potential upside for the Vancouver market, what we would, and actually I just noticed that the description on this slide is incorrect. This is the year over year appreciation for the Vancouver housing market. Under the upside scenario, going back to the discussion I had before about savings, if the spending out of savings is much stronger than we expected, if business investment in productivity growth is stronger than expected, we could get this upside scenario where house prices don't pause; they just keep growing. However, on the downside scenario, we see much more variation. So, given that prices are very elevated in the Vancouver area, there's much more room to fall than there is to rise. So if we start mixing in some downside assumptions where, the pandemic worsens, the pullback on monetary stimulus causes a sharp drop in stock prices and, financial market turbulence. We also add in some sort of political volatility related to, the U.S.-China relationship and the internal political affairs of the EU. If we add in a lot of those downside, assumptions, we can see that we could get some potentially some large declines in the Vancouver market. I would say, even under the most extreme scenario, which is our S4 downside scenario, the peak to trough decline in prices is about 30%. I would say though that, it's important to note that, given we've just had, 20% growth, it's giving back, a little bit more than we just gained. But, I think even in like the worst case scenario, what we're thinking about is, prices falling, a little bit farther than they were pre-pandemic. So, certainly an ugly scenario to think about. But, I guess it's just, going back to roughly, where we were in 2019 or so. So I'll pause there. We're nearly out of time. I don't know if there's any questions. I didn't see any pop up, but I'll hand it over to Yvonne.
Great. Thanks, Brendan, and thanks, Brian. Yeah, we had a couple of questions. What we're going to do, because we do want to end on time, I know people have busy schedules, so we will send some answers specifically to those people. And a big thank you to our speakers for your insights, the helpful information you shared, and as always, super interesting and very practical. So thank you. And a big thank you to our audience for joining us and participating in this session. As I noted earlier, we have recorded the webinar. We will share that with you along with a deck. You'll also see a survey. Obviously, we would love to hear from you, what you liked, what we can do better. We're always looking to improve. And also, please feel free to reach out to your RPS or Moody's Analytics teams if there's anything that we can help you with, if you want to collaborate with us, questions, whatever that might be. We hope you see us as your trusted partners, and we work hard to be so. So a final thank you. We hope you, your families and colleagues all stay safe and healthy. And we wish you a happy holiday season. I know that seems a little bit early for that, but it is coming fast. So thanks so much and take care.